Online sales tax and a guide to economic nexus in e-commerce. On June 21st, 2018, South Dakota vs. Wayfair Incorporated overturned a 1992 Supreme Court ruling which states can now require e-commerce businesses to pay sales tax where those businesses have an economic presence or nexus, as it's known. The process of tracking individual state sales tax that enforce economic nexus can be daunting, time-consuming, and expensive. And there's many different ways to handle this. There's a common accounting mistake that many e-commerce businesses unknowingly make that can cost millions of dollars and even lead to bankruptcy. If your e-commerce business sells to customers all over the US and is in hyper-growth mode, you're going to want to keep reading and listening to this video. Essentially, the South Dakota vs. Wayfair decision overturned a 1992 ruling known as QUIL that prohibited states from charging sales tax to companies that don't have a physical presence within the state. Because of this new ruling, your business is now on the hook for tracking and paying sales tax in every state in which you meet the threshold for economic nexus. If that isn't stressful enough, each state has its own set of rules for sales tax. Worse, in some states, counties and cities also have this power, meaning that businesses will need to understand and continually stay up to date as laws change across over 12,000 jurisdictions in the U.S. In keeping track of each individual state-specific sales tax laws and economic nexus thresholds, and ensuring that your business doesn't get sued, which can be expensive and an ongoing challenge, and sometimes destroy it. Number one, understand why states want to enforce new tax laws. Before e-commerce, remote sellers in the U.S. were mostly catalog retailers, accepting orders through the mail and via telephone. They only collected and paid sales tax on transactions with buyers in states where they had a physical location. Then North Dakota passed a law in the 1990s requiring sales tax collection from all retailers that advertise to customers in the state. Quill Corporation was a Delaware catalog retailer selling office supplies with locations in Illinois, California, and Georgia. The company sold office supplies to North Dakota customers by phone and mail order and shipped catalogs to residents. Quill refused to pay the sales tax and North Dakota sued. The result was a Supreme Court ruling, and Quill didn't have to collect sales tax from North Dakota customers. Neither did any other company that didn't have a substantial physical presence in the state. Back in 1992, remote sales accounted for only a small fraction of total retail, and few people even had an email address or shopped online. Even a decade after Quill in 2002, e-commerce still only amounted to $42 billion in the US. Today, worldwide shipping seasons like Black Friday, Cyber Monday, and flash sale product drops has caused that number to sit at over $500 billion. And that continues to grow. In a few years, it'll be $1 trillion. Amazon saw the Quill decision as an opportunity to grow without tax regulations that could hamper the growth of traditional retailers. As long as it didn't maintain a physical presence in a state, Amazon didn't have to charge and remit sales tax to the over 12,000 sales tax jurisdictions in the U.S. Quill had another benefit for Amazon. Customers realized that they could save a little money from websites that didn't charge sales tax, bringing more shoppers online. As a result, a rumor quickly spread that e-commerce transactions from out-of-state businesses were tax-free. In reality, consumers are supposed to pay use taxes on these sales, but almost none did. Sales tax revenue losses amounted to billions of dollars. Something had to give. Taxes would need to be increased significantly. Critical state services would need to be cut, or somehow, in spite of Quill, e-commerce sales would have to be taxed. Number two, know how South Dakota vs. Wayfair affects economic nexus. Until now, every bill that has attempted to change sales tax collection to allow collection from remote retailers, most notably the Marketplace Fairness Act proposed in 2011, 2013, and 2015, has faced too much controversy to even reach the U.S. President's desk for a signature or veto. The recent South Dakota vs. Wayfair decision means that your online business can now be liable for paying sales tax on orders made in states and counties where you do not even have a physical presence but do have an economic presence or nexus. The economic nexus criteria used by states to determine whether a retailer is liable for sales tax varies by state, but all help to level a playing field between non-collecting out-of-state sellers and the brick-and-mortar retailers located within. For example, a remote seller online or offline in South Dakota will trigger economic nexus when they generate $100,000 in taxable sales or 200 separate taxable sales transactions delivered into the state during the current or previous calendar year. Yet, Ohio's economic nexus law only applies to merchants that sell over $500,000 of taxable receipts into the state. You can also trigger nexus in some jurisdictions if you're using affiliate linking to sell products. Dropshipping like fulfillment by Amazon FBA can make you responsible for collecting and filling in states like Texas and Florida. In addition, nexus can be established by attending trade shows or by having an employee in another state doing anything business related, even checking email. That's why it's important to monitor the new law's individual requirements in your transaction in each state. In states like New York, whistleblower lawsuits make it profitable for attorneys to sue the non-compliant. So what can you do to avoid this situation? 3. Learn the state-by-state economic nexus laws. Without a solid understanding of state-by-state sales tax laws, you leave your business vulnerable to audit, fine, and repayment. And lawsuits can strike when you least expect it, and that's why you must learn the specific tax laws for each state in which you sell for your e-commerce business. You can start by understanding sourcing or the location where your sale is taxed. According to Avalara, an automated tax compliant software solution, origin source sales are taxed where the seller is located, while destination source sales are taxed at the location where the buyer takes possession of the item sold. As a seller, it is important to know whether you're located in an origin source state or a destination source state. Keep in mind, origin and destination sourcing rules work differently, and if you're a remote seller and have economic nexus, those states will most likely be destination based. As a result, you'll need to figure out the right sales tax rate for every location where your business has nexus. And as your business grows, so too will your customer base, resulting in an increase in states where you have an obligation to collect sales tax. Thankfully, if you sell to customers in a state where you don't have nexus, you don't have to collect sales tax. Unfortunately, there are only a handful of states that have yet to enforce economic nexus laws. 4. Ensure your e-commerce business is nexus compliant. Many companies start by complying with sales tax laws manually, using Department of Revenue notices for 1 or 2 states where they know they are required to file. Unfortunately, this method doesn't scale. What took just a few hours a month with one state could take 20 hours or more once a business's collection obligations expand due to trade show attendance, fulfillment by Amazon, dropshipping, or economic nexus. And here's the reality: growth happens, as can state sales tax complications and lawsuits, whether your business is ready or not. To avoid the risk of an expensive, difficult audit, a different kind of solution is needed. You could hire someone full-time to manage this for you in-house, but not all businesses have the budget to do so. Here's another way. 5. Automate sales tax bookkeeping and payments. Scalable cloud-based solutions like Avalara offer up-to-the-minute calculation accuracy, geolocation to pinpoint districts and rates, and automated filing. Avalara works with Shopify Plus to get sales tax right, whether you're filing in one state or dozens, even from outside the US. Automation saves time and it lowers risk. That's a great combination, since taking risk with sales tax can never legally result in higher profits. Also, the collection and filings are automated. Your e-commerce business doesn't have to avoid growth strategies that complicate your sales tax picture. You can expand where, when, and how you want without the red tape and hassle.